Hello traders, this is the second part of the bull put spread tutorial, and this is the dynamic component. The first component that you watched talked about all the key ingredients that go into the game plan that we have, and those will stand the test of time. That's why I stripped out the prices, stripped out the symbols. I just wanted you to focus on the concepts. Now this second part, I'm actually going to go in and take a look at current stocks. So you'll be able to see the symbols, you'll be able to see the prices, the dates, and we'll go in and see if we can find some good trades. We're also going to see if we can find some trades that don't quite live up to our expectations. So before I do that, I want to start off with the overall market. One thing I did not mention in the first video is that I don't like selling bull put spreads on the indices, like the SPY. Well, why is that? It's because currently option implied volatilities are near their historic low. You'll see that we're at about 205 on the SPY. We're going to click on option pricing. We'll go into February and we'll take a look at the 205 strike price and we'll click it. And then we could take a look at the option implied volatilities. It's 14. Remember, we're looking for something around 40 or higher. The reason for that is that the S&P is diversified. There are 500 stocks in it. Not any one stock is going to cause the index to go up or down dramatically. And that's why the IVs are very, very low. The other factor to that is that the market has been in rally mode, not just for the last few months, but if we zoom out and we go into a weekly chart, look at that rally. As the market moves higher and higher and higher, option implied volatilities collapse. They're actually at historic lows right now, and part of that is because central banks have been easing like mad. So the market has what's called a implied put underneath it. Every time market conditions waver or start to soften, guess what? The central banks are coming in with all sorts of stimulus packages, and then you get the market moving higher. Interest rates are near historic lows. They are at historic lows, actually, and that makes stocks attractive relative to bonds because the bonds aren't paying any interest. So that's another reason that option implied volatilities are very low. If you look at the IVs back in 2008 and 2009, absolutely they spiked up. Then it made sense to do bull put spreads. But right now, I don't like doing them on the indices. And here you can see on every market decline, we get a little blip higher in the VIX, but it still only gets to a reading of about, let's say 18 or so on these spikes. If I'm able to zoom out to a monthly chart, there you can see, now that VIX spike is probably, this is 16 right now, and that's probably 3 times that amount. So we're up in the 50 neighborhood. Oh my gosh, yes. Then you start looking at all sorts of strategies to sell option premium. Again, mind you, this is back in 2008, 2009. So we had a big spike right up in there. So in any case, I just wanted to let you know why I don't like selling options on, and actually let me confirm the date. No, the VIX is only going back to 2012. This is 2009. If we had a chart here, it'd be just way, way, way up here. So we've only had one good spike in it. So let's focus on individual stocks because that's really where we can make some money. I'm going to go back to a daily chart and I'm going to take that VIX off. I'm just going to type in SPY and enter it. And now we can take a look at what the market is doing. Everything I do starts with the market. You have to get your market bearings before you can do anything. 75% of all stocks follow the market. You've got to get this part of the puzzle right. So I'm going to put up a 100-day moving average. I'll put up a 200-day moving average. We can see that we had this big sell-off back in October, and we had a big snapback rally. The one thing that I'm noticing is that we're back above the 100-day moving average. So from a bull put spread standpoint, We've got a nice defined horizontal support level right in here. We've got our 100-day moving average that we can lean on. The market has been weak recently, and it's starting to bounce up a little bit. So it's all systems go as far as the market. I'm not going to say that we have an enormous tailwind right now pushing stocks higher, but we don't have the market working against us, and that's very, very important. I am seeing big volume on declines and light volume on rallies. That's a little bit concerning. Also concerning is the fact that we have hit this 100-day moving average with greater frequency. We've hit it 3 times in the last month. These cycles have normally been at least a month or two apart. So with greater frequency, we're testing that 100-day MA. Doesn't overly excite me, but the long-term market trend is still higher. We have earnings season coming up. That tends to be bullish for the market. So, as I mentioned earlier, at least we don't have the market working against us. As long as it treads water, we're fine selling bullish put spreads. Now we just have to find the right stocks. What I'm going to do is, again, I'm going to take these off. We know that the market is kind of neutral for us, and that's okay. I'm going to go into one of my systems because it's going to do a little bit of the homework for us. Remember, there are some key components that we have to have for our option trades. And let me remind you very quickly, we're looking for stocks that have good option liquidity. We're looking for stocks that have high option implied volatilities so that we can distance ourselves from the action. We're also looking for stocks that have performed well with the system versus a buy and hold strategy. We're also looking for stocks that are currently on a buy signal. We're also looking for technical support that we can lean on. So let's take a look at some of the stocks that we typically trade. This is one of the symbol groups. It's called high IV for good reason. These stocks have high option implied volatility. They are ideal for this type of trading. So I'd mentioned earlier, this stock has really been choppy. I can't classify it as being in a uptrend or a downtrend recently. It's choppy. It's gone from the high end of the range to the low end of the range. It has provided excellent signals. So we can see that our percentage gain for the system is up 122% versus 31% for a buy and hold strategy. So we've been able to get really good reliable trade signals off of the system. Now we get a buy signal right here. And incidentally, in the first video, you saw me referencing a stock with a $95 strike price. This is it. It was Zillow. And there's our nice support. We could take that trade right there, but it's pretty risky. Okay, I would prefer to take it once it's moved through that horizontal resistance level and lean on it right here. Now, that's right about the $104 level. So let's go in and take a look at the options. And we'll go into, now realize it has not announced earnings. We're going to go into the February expiration. We need to know when those earnings are going to be announced. We've got to be very careful that way. So I'm going to go down to the 100 strike, and then we'll look 5 points out, and we'll look at the 95s. So right now, I've got $4.10 bid on the 100s, $2.80 ask on the others, and there's a wide bid-ask spread of 30 cents on each one of these, so 60 cents total. If I look off the screen, I sell these for $4.10, I buy these for $2.80. That's a $1.30 credit, but I could probably squeeze another 20 cents out of that. So 150 would be the credit. Let's take a look and let's see what those option implied volatilities are like. And yes, this stock moves around, so they're at 60. Now I had mentioned to you in the first video that we don't want newsy stocks. We don't want biotech stocks that have FDA approvals coming up. This stock is just naturally volatile. it moves all over the place. Went through a big decline right there, big spike up there, rally, sell off, which incidentally the system happened to catch those moves very, very nicely. And then now we're getting choppy. It's up and down. So it fits all the criteria. The options liquidity might appear to be a little bit off, but I know in trading this that I can get fills between the bid ask, so it's better than it actually might look. Let's go to the next candidate, Yelp. Well, we have a couple of problems with Yelp. The first one is that the signal is currently bearish. So already we shouldn't be considering this until we get a bullish signal from the system. Also, the system has done well with this stock, 62% versus minus 25%. So we've got that working for us. Liquidity, probably not great, but we would know after analyzing the options if the liquidity is good enough for us to get a trade done. And that liquidity is actually measured by the platform. We're going to go in and take a look at the 55 puts just to gauge the option implied volatility, somewhere around 65. So excellent. We've got that working for it. Now here's what I'd like to see. You've got support right there. Then the stock comes down and it has this horizontal support right here. And that happens to line up with this high right in there. We're very close to it. I would like to see the stock go on a buy signal, and I would like to see it get above that $56 level. If it can do those two things, this would be an excellent candidate. It's not there yet. So for right now, I wouldn't touch it. And if it did get above that $56 level, I'd probably sell the 55.50 put spread. Okay, you'd have a little bit of cushion, a little bit of ability for it to move around. And hopefully on that breakout, that'll be the sign that buyers are back in and it'll continue to push higher. We'll take a look at Twitter. Twitter is on a buy signal right now. Got that working for us. We've got excellent liquidity. The system's actually done pretty well with it, up 17% versus minus 38%. So we've got that also working. Only thing is we need to see Twitter through this $40 price level. Okay, if we get that, then the trade becomes much more attractive. And if we want to play it a little bit safe, we can come down to this 37.50 strike price and sell the 37.50, 32.50. Now let's see what those options are trading for. Go out into February. Again, earnings is a huge factor right now. We've got to know when all these stocks are announcing earnings. So we're going to come in here. We'll take a look at the 37.50 puts. There we've got our option implied volatility close to 70. So it certainly meets that criteria. Let's say we're able to sell the 37.50s for $2. We would buy the 32.50s for 60 cents. That is a $1.40 credit. It certainly meets the $1 credit that I would be looking for. Now, I suspect that it's going to be announcing earnings in the next few days. I can look back here and say that, yes, on 10/24 they announced, so October 24th, November, December, January, they're probably going to be announcing next week. And that's one of the reasons that the option implied volatilities are so high. So let me sow this seed. I'd mentioned to you, I love selling premium right after the number. So we already know that $40 breakout is what we're looking for. Let's say that Twitter announces earnings in the next 2 days. We're on a buy signal. They announce, market likes the news, stock breaks out above $40. We're all over it. You could come in and sell the 40, 35, or that 37.50, 32.50 put spread, and we'll have everything that we need. We've got the stock falling, forming a base, rallying through horizontal resistance on a buy signal. DDD, steady downtrend. Okay, I don't like stocks in a downtrend. They're not my favorites. The good news is the option implied volatility is usually pretty high, but liquidity is good. System has performed well with the stock, 85% versus minus 48%. And you can see that it's on a sell right now. Not good. So we would not be interested in this trade. Even if it were on a buy signal, we needed to get through that horizontal resistance level right there at about $33. Then we can start getting somewhat excited about it. Letter P, Pandora. Well, we're up about 9% versus minus 52 for the stock, so we're doing okay. You can see a nice buy signal here if you're buying calls, but I don't like anything about this as far as a bull put spread trade. Yeah, we got the buy signal. Yeah, we got the liquidity. Yeah, we've done okay on it. The stock is still in a severe downtrend. And yes, you can say that that downtrend line has been broken and you could use that as your support. I don't like it. I want to make sure this is something more than a dead cat bounce. So I'd like to see it form more of a base in here and then rally through a resistance level. So I would have to say no way on that. Here we've got First Solar. System's been up 21% versus minus 12%. So yes, we've done well on it. Has decent option liquidity. Stock has also been in a downtrend. Well, we do have a defined support level here. That's good. I wouldn't want to touch this thing until it can get through that 45.50 level. If it can prove to me that it's got that kind of run in it, then I start getting interested in it. I also want to see that the stock volume is starting to move higher. Now we might get all of that if the company comes out and produces good earnings. But as it stands right now, without those criteria, wouldn't touch it. SCTY, another solar company. Talk about choppy. All over the place. We're up 66% versus minus 36%. So we've got excellent performance by the system. We've got excellent liquidity. We can see that it is volatile. So any high implied volatility is due to stock movement, not because there's an announcement due. And we've got some pretty big support right here at that 47.50 level, 47 level, right in this range right here. So we could really lean on that, and we just got a buy signal on it as well. So earnings were released. We probably have about 2 weeks until earnings are released. So we've got a little bit of time. Now, mind you, when you sell options that span earnings, meaning that the options expire after the earnings announcement, those options tend to be very resilient. They hold their premium well because there's big news pending. So if you went in and said, well, I'm going to sell this put spread, knowing that they release in 2 weeks and some premium is going to come out, probably not a lot unless the stock runs higher, which is very possible. And in fact, I've got a study that shows us what the stocks tend to do into earnings. And I'm going to click on that right now. And here you can see the percentage gain 1 week before earnings. Previously, the stock had an excellent track record of rallying into earnings. And actually, in the last quarter, it did as well. But it's had a few soft quarters in there recently. So back in here, it was, yeah, kind of a no-brainer. It would move higher. It's a very nice gauge to use. And there's your gauge 2 weeks before earnings. So we can see that the stock does have a tendency to rally. And it can rally anywhere from 10 to 20%, but 10% seems to be the normal average rally. And it tends to decline 10% as well. But given that we're at the low end of the range, my suspicion is that it'll probably move higher into the middle of the range. So this might be a decent candidate, but this is a little bit riskier than I'd advocate. Okay, this is kind of like the Zillow trade we looked at earlier. If you come in and you start to see the stock moving higher and you want to take a little more risk, you'd sell that 47.50 put, you'd buy the 42.50 put, and you'd keep a very, very tight stop at it because you're just at the money. So this is a bullish trade. This is not a neutral trade. You're going right at it. We're going to take a look at the option pricing very quickly here. And on this one, let's get really aggressive. Let's assume that it announces after the weekly options expire next week. So take a look at the 4750 puts, and we could see that the option implied volatility there is somewhere in that 55 range. So it certainly meets that criteria. And then we'll look at the 4250s. Well, you can see the bid ask is 4 cents bid offered at 24 cents. And this is a fairly wide bid ask. So I'm going to say that we can sell these for 90 cents. And I'm going to say that we can buy these for 20 cents. That would be a 70-cent credit. I think you could probably even do better than that. Maybe you could get closer to 75 cents. And that might be a nice trade, especially if you're willing to go on the premise that we've got the buy signal. We have a tendency for the stock to rally into earnings. It's at the low end of its trading range currently. Yeah, but you're going to keep that stop at that 47.50 price level. If the stock closes below 47.50, which is our short strike price, you've got to be out. And hey, Pete, where's that technical support that we want to lean on? It's right there at 47.50. Okay, so we don't have a lot of breathing room in this one. You're just looking for the stock to maintain its price level for the next week, which options expiration is 5 days away. Tends to be this is a very speculative bull put spread. Okay, that's not really what I'm advocating. I like to be a little bit more conservative, but if you're an active trader, I think that's probably a good trade. Let's take a look at other stocks, and I'm going to use my scanner to find them. Now, I had talked about a couple of different formations. One is a reversal, and that means that the stock is in a long-term uptrend, but it's been in a short-term downtrend. Well, this is Google. We all know that Google's been moving higher and higher for many years, but recently, this is pretty soft price action. And you can see that we went on actually a very good buy signal right here. However, would I have come in and sold a put spread? I could have leaned on that price level right there. Now, what I'd mentioned to you is I want to see this stock above a technical level before I go in and sell that put spread, especially when it's been in a downtrend. So I would prefer to do something up in here. Personally, I know that Google announces earnings in 4 days, so there's not a lot of time to work with. So we're going to take a pass on this, but I certainly could have come in if I were speculating, said, hey, there's my defined support right there at 495. I've got my buy signal, sell a 495, 490 put spread, keep a tight stop, look for the stock to move higher on that buy signal. If you'd have done that, you'd be in great shape. Or you can start to look at it and play it a little bit safer. Right now, you've got to take a pass because earnings are coming up. But let's say the earnings were behind us. Now you can look at this price level right here and sell the 530, 525 put spread. I'm also going to overlay the 100-day moving average. If the stock happens to get above that 100-day moving average when earnings come out, now you've got another technical support level that you can lean on. So you've got horizontal support at 535. You've got your 100-day moving average roughly around 540. Two really big numbers there, big support levels. And you've got your buy signal. So now I've got multiple check boxes marked off. We'll keep taking a look here. Poor liquidity. Poor liquidity, but pretty interesting trade here. Let's assume that the liquidity is good. Let's also assume, let's see, earnings. It's coming up on earnings just based on a 3-month cycle here. But I do like an awful lot about this current chart. Number one is you do have an uptrend right here. Second of all is you have a stock that had a breakout here and a massive gap higher after earnings right there. And it pretty much comes back and it fills in that entire gap. So now you have the stock back above the 100-day moving average and you've got your buy signal. So I do like an awful lot about this. And at this juncture, I would probably, you've got support at 123. If you did a 120, 115 put spread, let's take a look at it real quick and see if we've got our prices that we need. Again, I don't know when earnings are. And I can see here that there's no way. Look at those bid-ask spreads. 85 cents bid offered at $1.40, $1.55 by 220. The option implied volatility is at the 40 level, so that's good, but there's just no way we can trade this. It's a mile-wide market. VMware, high option implied volatility, has good liquidity. I know you can get trades done on this. We've got our buy signal. Still below the 100-day moving average. It's been in a downtrend. I'd like to see it above that horizontal resistance level at $85. Then I'd feel pretty good about going in and doing this trade. And I'm just looking for stocks that I know have decent option liquidity. And you'll notice that a lot of these stocks have been in a downtrend. Well, the market has been pretty soft so far at the start of the year, and a lot of stocks have been hit pretty hard. This is CLR, good option liquidity. System's up 123% versus down 60%, so we have that working in our favor. We've got a nice buy signal. We've got good stock volume here. We've got the stock moving through a horizontal resistance level right there. That's good news at that $40 strike. That's what we can use to lean on, the $40 strike price. And we're above the 50-day moving average, so that helps. And that's right at that $40 price as well. So we got all the components that we need to do this trade. Now let's take a look and see what the option implied volatilities are like. And we'll go into the FEBs. And you can see fairly tight bid-ask spreads. Option implied volatility of 70. You can see that the options spiked to about 90. So they're very, very rich. And we'll go back to that chart. Actually, let me go back to the option pricing and look at the spread. So you could sell the $40 puts for $1.55. Let's say $1.60, and you could buy those for 60. There's your $1 credit right there. I'm sure it's coming up on earnings though. So let's review the risk reward profile on that trade since we're at it. Just want to reinforce what I taught in the previous video. So we saw that $40 put. If the stock moves below $40, that is our stop out point. Now our risk starts to accelerate when it drops below $40 because the put buyer, the guy that we sold the put to, he can exercise his right to sell that stock at $40 and we would have to buy it. So you have to want that stock at $40 because if it drops to $30, you're going to be left holding the bag. So the mentality going in is, yeah, I'd like to own the stock at $40. Well, look, it's got all these other good things working for it. Stock is moving higher. Feel good about, the overall technicals and the performance of the system. But we are not going to, in this particular case, we're not going to be buying that stock at $40 because if it drops below it, we're going to stop the trade out. We're going to move on and look for the next trade. So we've got a relatively short-term perspective on this investment. We're just trying to go off of the technicals and go off of the system reading, look for stocks that have good liquidity. Those are our advantages. Those are our check boxes that increase our probability of success. So with the stock currently at 43, it could move 3 points lower to our strike price of $40, and we're still okay at option expiration. We get to keep our $1. It could stay flat right here at $43. We're fine with that. We make our dollar. If the stock moves higher, the option premiums collapse and we'll be able to buy our spread in for a profit much earlier than expiration. And then we can look for the next trade. So 3 of the 4 scenarios are excellent for us. We just have to protect ourselves from the one scenario where the stock pulls back, which incidentally, if you look at your return on investment, I'd mentioned before that it's the difference in the strike price, in this case $5, 40 minus 35. So we've got $5 between the strike prices. We collect $1 in premium. So we would make $1 on a $4 investment. That's a 25% return in 1 month. It's an excellent return. So we know that not all of them are going to work out for us, and that's why we have to make sure that when they're not working out, we buy them back. But when the majority of them work out, that's a fantastic return, and that's what you should be shooting for, somewhere in the neighborhood of maybe a 70% success rate. If you use those check boxes that I've been talking about, believe me, your odds of success are going to go up dramatically. So there's not much here for us to look at. Stock is choppy. It's formed a nice base. I'd be interested above here. Yum. Okay option liquidity. Stock has been in a general uptrend. We've got it breaking through horizontal resistance right here. We know that we'll probably have earnings coming up very quickly, but let's assume that earnings were just announced, then this would be a great trade. I'd be all over that. It might not have the option implied volatility that we're looking for, but this $74 breakout, I like. So let's go in, let's just go through the motions here and see what the $75 puts are trading for. And we do have a few different strikes here, which is good. So we'll take a look at those 74 puts. And yeah, there you go. They're at about 25.25 implied volatility. Just not rich enough for us to want to do a trade. So let me pose this to you. Gosh, dang it, Pete. Everything else looked so good on this one. I really wanted to do that trade. I didn't say it wasn't a good trade. I just said it wasn't a good bull put spread. Those options are relatively cheap. Buy them. Buy calls. That's your strategy here. Okay? And so we go in, take a look at the option prices again, and we could look at that $75 call, and you've got those 147 bid offered at 156. You could probably buy them for $1.53 or so. And they're February options, so you got some pretty good time till expiration. There's a good chance that the stock will continue to move higher. But as you look at the stock, realize that even though this looks like a big price movement, it's really from $74 to $78. So the stock doesn't tend to move much. If I were looking for a dollar or two move in this case, I'd have to go in the money. I want to get my deltas up as high as I can, and I don't want to pay a lot of time premium. And I might have to buy the $70 calls, but they're going to move point for point, and I can take my profits along the way. I'm getting a little bit off track, but I do want to emphasize this. So 470 by 505, you can buy these for 490, I'm sure. We'll take a look at the chart. Stock's at 74.10. If I buy them for 490, I'm only paying 80 cents over in option premium. So if this stock continues to push higher, that option is going to move pretty close to point for point, and I'll be able to take my profits along the way and move on. And I might only need $1 or two move out of this. So just because there isn't high option implied volatility doesn't mean that we don't do the trade. It just means that we don't do a bull put spread. So again, those are reversals, stocks that are in an uptrend but have pulled back, and now that pullback is reversing. That's what's reversing. The other type of trade is a continuation trade. That would be a trade where the stock just continuing to move higher and higher and higher. I know these are, well, let me click on it. Ah, look at that. That's awesome. This is, great, blah, blah, blah. Uptrend, gap higher, comes back and tests the breakout, succeeds, get your buy signal, making a new high. There's only one problem. This is a biotech company and very, very newsy. So I would, that is a news item right there. We don't like gaps. Gaps are a warning sign to us. In this case, it was a gap higher, but it could also be a gap lower at any other point in time. So I really tend to avoid those. But otherwise, yes, that would have been a nice candidate. System has done very well with it, 69% versus 23%. Lulu, Lululemon. This is a nice rally up. We had the earnings breakout, good buy signal, still on that buy signal. Talk about a great buy signal. And now it's just getting a little bit too lofty for me, quite honestly. I can't, in good conscience, sell a I can't sell a bull put spread on this. And I might be a call buyer in here, very light on that breakout right there. But once it's up in here, it's gotten away. You had to be in here, which incidentally, I was in here on this trade. I did like everything about it. So it's been a nice trade for me. I was out up in here though. It pretty much I thought had run its course. I was wrong, but I'm still happy I did the trade. Okay, I'm still looking for something with good liquidity. This breakout, if it weren't for that earnings, would have been great to sell a put spread right on that breakout, and we would use that $75 strike. But you had earnings, so we do not hold over earnings. Now it's back in on a buy signal after the earnings announcement. Probably a good trade, but it's just getting a little bit ahead of itself for me. So I am going to take a look. I do want to see, well, holy cow, that's why it's up so much. Look at the earnings growth rate, revenue growth rate year over year was at 50%. 50%. Okay, we could take a look at this chart called E reaction here, and we can also see what the stock did after earnings. It gapped up and then kind of held that level pretty well. And there we can see earnings percent change quarter over quarter. So didn't come through on the earnings side, but it sure had a huge spike in revenues. And I know that's what's got to be driving the stock higher. And I'm not seeing a whole lot of stocks with great liquidity in here. And I'm hoping to find a few. So let's keep looking at some different searches. I'm just going to keep clicking through. This is a pretty good one, and this is actually one that I would consider. You've got beautiful uptrend. One thing I didn't mention, I need to overlay that because this will be a good example. I'm going to type in LUV and then I'm going to type in SPY so that we can see the relative strength. So you got the stock moving up, market tanks, stock holds its own. Market rebounds, stock inches higher, get another huge sell-off in the market, stock holds its own. Soon as the market starts to recover, boom, stock higher. Stock making a new relative high, so we've got that relative strength that I love to look for. Stock making a new relative high, you've got a breakout right there. You can lean on the $43 strike. Yeah, I would do that all day long, especially after that earnings announcement and the stock moving higher. You're on a buy signal. So let's take a look at the option implied volatilities and see where they're at. And we'll take a look at the 45 puts. And there you go, you're down at the 30 level. Now this brings up an excellent, excellent, excellent point. So, gosh, I love Southwest Airlines. Those airline stocks are going to make so much money. Oil has been dropping. Their passenger miles are up. I'm going to buy some of these calls before they announce earnings because that stock is certainly going to move higher. and you look at it, and they're trading at an implied volatility of 70, very, very high. That is sell territory for us. And the next day, you could very easily, you could see how the option premiums have fallen down to 35. That's because of the earnings announcement. And you can oftentimes find that you buy your calls right here before the earnings announcement, and the stock moves up huge, and you lose money on the trade. Now, in this case, you probably would have made a little bit of money because it did make close to a 10% move. But oftentimes, you're going to get a 4 or 5% move in the underlying stock, and you're going to lose money on those options when you buy them before the numbers. So be very, very careful trading before earnings announcements. And that goes for buying as well as selling. But now after the event, with the implied volatilities where they are, you have to be an option buyer. There's no bull put spread for us there. And I am just looking for one more good liquid stock that I can show you. And so I'm just looking for my searches. These are breakouts, so we know that they're already breaking through horizontal resistance, which is good. NTES, we had that buy signal way, way back here. And this is where I'd like to catch that trade when it's breaking through that horizontal resistance at 107. Then I think you can get in here. Otherwise, it's too far from us. This one I like, and that earnings announcement was on November 20th, roughly. So we've got time on this. I like this trade. I just wish the option liquidity were a little bit better. And you can see the breakout there at $78, and we've got our buy signal. So let's take a look and see. Option implied volatility are 25. So below our desired threshold. If I were going to structure a trade though, I would sell those 77.50s and I would buy the 72.50s. So you could get, let's say, $1.10 for these, and the 72.50s, let's say you can buy those for 30 cents. You're going to be able to get 80-cent credit, a little bit below what I would prefer to have. But this is probably a pretty good trade nonetheless. So I wouldn't be doing a bull put spread. I'd probably be out there buying calls on this because the stock looks like it wants to continue to move higher. And I honestly don't see anything else that's going to give us high option implied volatility. So I've got to go back into my systems and see if I can find something else. We'll go into a Tesla, and I actually did sell some put spreads on this last week, and I keyed off of that 190 level. I'm a happy camper right now, but that was a fairly aggressive trade that I did. UA is on a short right now. Gilead is a biotech, so we try and avoid those. Apple is going to announce earnings on Tuesday, so that's not going to work out very well for us. And Apple, I'd want to see it above this level here, then I'd feel good trying a put spread. But it has low option implied volatilities. VMware we talked about, I'd like it above this level. And after earnings, I'd feel very comfortable with that. So if it gets through that $84 level, and we'll take a look at the option pricing on it, and we'll go into the February expiration, and we can take a look at those 82.50 puts, about 40, a little bit under 40, but pretty much in our range. And so if we sell the 82.50s and we buy the 77.50s, we can get a nice credit for that. Right now it's about $1.60. You could probably get $1.70 for that spread, but I'm sure that's because earnings are coming up and the option implied volatilities are relatively high. So again, VMware, we're on a buy right now. If it can get through that $85 level after earnings, wham, you're in it that morning. Sell that 85 put, buy the $80 put. Look for the stock to continue higher and for some of that option implied volatility to come out. Finally, we'll go into internet. Okay, Amazon's announcing in 3 days, so that's not good. Uh, Google we already looked at. We'll look at F5 and we'll look at Yahoo, and then we'll conclude this portion of the presentation. Now there's F5. That's why we don't like to be out for earnings announcements. That stock fell from $127 down to $108. That was almost a $20 drop. Yikes. We do get a buy signal in it right here. This would be only for day traders, very aggressive traders. We have nothing here to lean on except for that 108 price down in here, and that is a longer term support level as well. So this I would deem a very, very speculative trade. Okay, I can't say yes, do it, or no, don't do it. It really it is dependent upon your risk profile. I'm going to zoom out very quickly. We're going to take a look at a weekly chart. Stock has been in a longer term uptrend, so we've got that working in our favor. And we've got a fairly nice trend line there to lean on, but the stock is on the verge of breaking below that trend line. So lots of caution is warranted for this particular play. It's below the 100-day moving average. It's below the 200-day moving average. So dangerous play, but if we were to just take a look at it, here's how we would approach the trade. Go into the option pricing, go into the Feb options. We're going to be looking to distance ourselves as much as possible. So I'm going to be coming down here to the 110 puts, and there we can see that the option implied volatility has dropped way down to 25. It was up around that $40 or 40 level. Now it's down to 25. So there's nothing there for us. If we sold the 110 puts, we'd get $1.30. If we bought the 105s, we'd have to pay 65 cents for it. So we get hardly anything here. I mean, that's such a small credit. Just not worth it. You get 65 cents for a credit spread. We're not going to be doing that. If anything, you were going to play this bounce, you'd have to go in and buy the options because they're relatively cheap right now. But I personally, I wouldn't even touch it. The stock needs time. It needs to form a base. Yahoo, coming up on earnings as well, in a bit of a downtrend right here. So that's a little concerning. It is back above that support level right there, but not enough for me to want to go out and do a trade. Obviously, not with earnings coming up. Now we want to always overlay our major moving averages. So the 200 is so low that it doesn't really provide us with any kind of safety net, but that 100 does, and that happens to be that $46 price level. So I don't like the trade personally, but if I were going to do one, it would be keying off of that $46 support. One other key is that we haven't done particularly well on Yahoo. The system's down 4% versus buy and hold up 41%. I know part of that is because we don't participate in earnings, and when there's a big earnings gap like that, that's where the system really fails to keep pace with a buy and hold strategy. I'm okay with that though. I don't want to be out there over earnings season, so I'd rather avoid situations like the F5 collapse than to try and capitalize on moves like that. I just want to avoid the risk as much as possible. So I can't say that I would do Yahoo either. We've had a few really nice candidates. We've had some that I've shown you that I think will be good candidates as soon as that earnings report comes out. If the stock makes it above that horizontal resistance level, it's already on a buy signal. Those would present really, really nice opportunities. And I've also shown you some opportunities where you don't even want to touch it because the stock is still in a very severe downtrend, and we need time for it to form a base and move higher. So I hope this gives you a really clear understanding of the checklist that you need to go through. And I will be adding these videos from time to time. Maybe I'll do one every couple of months or so just to keep it current and to keep refreshing the process that you need to go through. But bullish put spreads are a very, very, very powerful strategy, especially when there's uncertainty in the marketplace and the market's not trending higher and it's kind of chopping around like it is currently. Then you want to give yourself as much cushion as you possibly can. You want to distance yourself from the action, take advantage of that high option implied volatility, put your stops in, let time decay take care of the rest. Lean on the system signals, lean on technical support, and you will greatly enhance your probability of success. Thank you.